Shock and disbelief reverberated through the crypto community the moment we discovered that, seemingly overnight, the number of massive whale addresses holding at least 10 Bitcoin catapulted to a figure not seen since March 12th. Are these whale investors picking up discounted coins during a moment of market hesitation, or do they know something so powerful and game-changing that the rest of us can only gaze on in speculation? Today we will dive headfirst into this cryptic whale activity and explore the reasons behind this sudden surge, revealing the hidden signals that might just indicate the start of another powerful run in the Bitcoin universe. We will also analyze the role of dominant institutional inflows, highlight impressive spikes in number of addresses, and investigate just how stable the king of cryptocurrencies remains below that critical $108,000 to $110,000 resistance band. In this episode, we will tackle the elephant in the room. Do these whale addresses know something the general public has not come around to yet? We will examine key points like the surge to 152,280 addresses that hold at least 10 Bitcoin, what it means for deep-pocketed players to be increasing their positions, and how so-called retail panic might be fueling these illiquid wallets. We will also trace the footprints of massive institutional investors who appear to be snatching up more digital gold than ever, chasing after new corners of profit and adding to the narrative of a swiftly maturing crypto market. Stick around as we decode the signals that could mean a dramatic, world-shaking shift is right around the corner. Let us set the stage with something that might send chills down the spine of any retail investor. Experienced market analysts are pointing to the possibility that whales, those enormous, deep-pocketed players, are capitalizing on the period of caution that many smaller holders currently face. In particular, these veterans refer to a phenomenon wherein so-called smart money arrives right at the point when fear lurks in the market, hoovering up available coins at advantageous prices. From the outside, it might appear that retail investors are focusing on negative headlines, ongoing regulatory uncertainties, or even short-term profit-taking. Meanwhile, the whales and sharks are stepping up to the table and gobbling up what we can only assume they see as a relative bargain. Some in the cryptosphere have labeled this as a silent feeding frenzy that marks a decisive moment for Bitcoin's next potential leap. Indeed, the numbers speak loud and clear. The number of wallets holding at least 10 Bitcoin recently hit 152,280, a quantity that ignites eyebrows across the board. Why? Because that figure was last achieved right around March 12th, a milestone date etched in the minds of many. Back then, as analysts combed the on-chain data, they discovered that experienced investors were steadily building rewardable positions. Today it appears we have come full circle. The reasons for such activity can be complex, ranging from increased adoption in sovereign funds to speculation about upcoming shifts in monetary policy, but the consistent factor is that these whales appear unafraid of near-term dips. Looking deeper into the chain of events, we find crypto watchers who are highlighting the massive inflows from institutions into spot Bitcoin exchange-traded funds, a direct correlation with whale confidence. Over the last few weeks, the market intelligence platform Santiment observed that some of the largest wallets in existence have been adding digital gold quicker than your average person might rush to claim holiday discounts. And this begs the question, is the rest of the crypto community missing out on vital clues? Let us recall a telling pattern from recent Bitcoin market history. Whenever institutional gelato-like inflows appear, it often heralds a major price rally. However, observers note that, in this instance, there is considerable price stagnation below crucial resistance. One might naturally ask then, why are the whales buying so aggressively if the price remains locked in the $107,000 to $108,000 region? Could this be the quiet before the storm? Interestingly, market insiders point to about $66 billion in realized profits over the past 2 months, a figure gleaned from short-term traders who have been trying to lock in gains while the price soared above the psychologically significant $100,000 threshold. Remarkably, as these sellers exit, new demand has arrived, scooping up their abandoned positions. This swiftness of absorption signals strong buy-side power. Why would fresh demand be so robust? Either we are seeing new waves of institutional money marching in, or the older whales are doubling down on their long-term bets. Or perhaps it is a swirling combination of both. When the dust settles, the data reveals that price has remained surprisingly resilient, suggesting that there is a persistent appetite whenever Bitcoin dips even slightly. Let us not forget the story about Binance, one of the largest crypto exchanges in the world, where nearly 4,500 Bitcoin were withdrawn in a single day. Around the same time, about $800 million in stablecoins flooded into the exchange ecosystem, a dual move that often indicates seasoned traders want to pivot quickly into comfortable positions. On that day, speculation ran high. Observers said, "Is the big move happening now?" Eventually, the action moderated, but not before it left an undeniable footprint for the on-chain sleuths to decipher. Of course, one cannot talk about big investment inflows in the current Bitcoin climate without referencing spot Bitcoin exchange-traded funds. They have been pulling in nearly $1.5 billion in mere days, a staggering haul by any standard of measurement. Among those fueling this momentum is BlackRock's iShares Bitcoin Trust, also called IIBIT, which has reportedly snapped up 9,400 Bitcoin in the last week alone. This extraordinary accumulation offers multiple signals. First, some believe it legitimizes Bitcoin in the eyes of traditional finance. Second, it raises further suspicion that professional money managers foresee a major bull wave on the horizon. Now let us transition into the current price action. While we might be enthralled by surging whale addresses and institutional mania, Bitcoin itself has seen sideways motion, trading around $107,353, down about 0.4% in the last day and about 2.6% over the past 7 days. For some, this might look like an unremarkable lull, a moment in which the king of crypto is simply catching its breath. But for the whales, these quieter intervals often serve as windows to amass bigger pots. In other words, while panic sellers fret over whether they should hunker down or cut losses, the deep-pocketed investors appear to be calmly pulling digital coins out of circulation. Interestingly, the future is no less uncertain today than it was at any critical juncture in Bitcoin's timeline. The difference now might lie in how the playing field is arranged. On one side, you have a giant wave of old-school retail holders, some of whom have grown tired of waiting for the promised land beyond $110,000, or are looking to rotate into other altcoins that have demonstrated short bursts of significant gains. Meanwhile, big-time whales show little sign of letting go of their holdings. For them, short-term fluctuations are little more than static, a background noise drowned out by the historically proven pattern of Bitcoin climbing to new heights with each halving cycle and wave of adoption. Before we move forward, if you are struck by the depths of these strategic moves and feel a rising curiosity about how the biggest market players orchestrate their plays, go ahead and tap that like button. It supports our dive into these complex subjects, and it also helps more enthusiasts discover the mysterious mechanics behind Bitcoin's unstoppable journey. At the heart of this entire situation is an essential question. Did the whales foresee trouble brewing in global markets, prompting them to shift capital sooner rather than later? Or do they sense an impending catalyst that retail traders have yet to grasp? Pundits point to possible triggers, such as renewed talk of crypto-friendly legislation in certain jurisdictions, or looming inflation concerns in major economies that increase the attractiveness of scarce decentralized assets. Some talk about the possibility that Bitcoin might become the prime safe haven asset for large funds seeking to hedge against everything from currency devaluation to broad-based market risk. Another key data point that has watchers buzzing is that Bitcoin's dominance stands around 62.8%, having previously touched a commanding 65.7%, its highest level in 4 years. In the labyrinth of the crypto universe, that level of dominance implies capital flows that are leaning heavily into Bitcoin instead of altcoins. Why does that matter? Because typically, when the market is bullish on altcoins, we see money trickle down from Bitcoin. But in times when Bitcoin dominance grows, it suggests a pivot towards safer, more time-tested crypto assets, reinforcing the notion that institutional players prefer the perceived stability of the oldest and most famous digital coin. Some analysts also highlight an interesting interplay between realized profits and the price resilience. Short-term holders managed around $66 billion in profit-taking, presumably clearing the runway for a fresh wave of participants. Meanwhile, the new wave piling in might not be the typical retail crowd, but instead large funds, newly minted whales, or returning sharks who sense that even near $107,000, Bitcoin remains a bargain compared to where it might be heading once the next bull run gets into full swing. For these confident accumulators, the mere fact that price remains stable in the face of considerable selling is arguably a testament to the multi-layered strength of the crypto's demand. As we move closer to unraveling the big picture, let us recall that this entire mosaic lines up with an enormous narrative about the future of decentralized finance. The mere fact that institutions are funneling capital into spot Bitcoin exchange-traded funds underscores a deeper legitimacy than anything we have seen before. For the average onlooker, it might be a sign that digital coins are maturing from a speculative fad into a recognized strategic asset class that certain giant entities can no longer ignore. The presence of iShares Bitcoin Trust, among others, sets a tone of credibility that might push hesitant institutions to finally dip their toes or wade in more aggressively. Nevertheless, caution is the name of the game in a realm as unpredictable as crypto. Some critics ask, if whales are stockpiling, does that guarantee a run-up in the price? The simple answer is no. There is no definitive guarantee in any market, let alone one as famously volatile as crypto. But the history of Bitcoin strongly suggests that whale behavior is a substantial predictor of long-term trends. Typically, whales do not risk capital lightly. If the data shows a swarm of them buying, then in many past cycles, it has presaged a robust upward movement over the following weeks or months. That does not account for external black swan events, of course, but it is a pattern repeated often enough to garner attention. Even so, not everyone wants to buy when the price has hovered above $100,000 for some time. Some smaller investors recall numerous stories of abrupt market downturns. They wonder if this entire calm environment could be luring unsuspecting participants into a trap. The question then becomes, is a precipitous drop waiting just around the corner? If we look at on-chain metrics, including the shifts in dormant addresses, stablecoin inflows, or the ratio of buying to selling pressure, we see that overall investor sentiment remains steadier than it might appear from short-term swings. This leads to the narrative that when the price does eventually decide on a direction, the upward momentum could be swift and unstoppable, especially if whales keep adding. Some watchers, such as market commentator Axel Adler Jr., conjecture that the resilience of Bitcoin right now, despite an enormous sum in short-term realized profits, indicates that new buyers are more than happy to absorb the supply. The only question is how soon this new wave will tilt the scale and push the price beyond that tricky band of $108,000 to $110,000 that has kept the coin subdued for a while. We should also keep in mind that calls for a new all-time high continue to increase in volume. Traders like Dan Crypto Trades believe that if the price can break beyond the wedge that is formed, it might quickly ascend to new uncharted zones. We have to ask, just what kind of catalyst will it take to crack that wedge? Is it an update or acceptance of a major spot exchange-traded fund application, big corporate adoption, an unexpected macroeconomic pivot, or a confluence of all the above? For now, it is a waiting game, but it is one filled with excitement, tension, and the intangible sense that a big revelation might just be around the corner. At the same time, altcoins have been overshadowed by Bitcoin's rising dominance. Though pockets of altcoins still deliver short bursts of staggering gains now and again, the prevailing story is that big capital is being deployed into the more stable and recognized store of value. Some altcoin enthusiasts worry that if Bitcoin's dominance continues upward, it might starve many smaller projects of the liquidity they need to thrive. On the other hand, die-hard Bitcoin maximalists interpret this as a sign that the original cryptocurrency has consolidated its standing as the digital asset of choice. Whichever angle you prefer, the underlying phenomenon remains. Bitcoin is the magnet pulling in the lion's share of capital. If the scope of these whale moves, institutional inflows, and unwavering price floors resonates with you, kindly consider subscribing to this channel so you will not miss our next deep dive into how these forces converge to write the next chapter of crypto history. Whether you are a veteran or a newcomer, the developments of the past weeks show that the stakes are higher than ever. Still, today's environment is not the carefree mania of earlier surges. We have seen a good chunk of participants raking in profits, and there has been enough volatility to rattle many nerves. Yet the consistent reappearance of buyer support each time the price dips signals that the dream of a more widely adopted, more integrated Bitcoin persists. The question that emerges is, when the whales decide they have accumulated enough, will they trigger a run that leaves the hesitant in the dust? Ironically, one of the factors that might power future growth is that many short-term traders are still not fully convinced we are heading for a major rally. They highlight the gap between the reality of regulatory uncertainty, potential global recessions in some regions, and the repeated stumbling blocks that appear in the quest to push above $110,000. This skepticism can be potent rocket fuel if the market veers bullish. When convinced, these borderline participants become forced buyers, driving momentum even higher. Adding to that equation is the broader transformation of consumer and investor mindset. Over the years, countless individuals have come to see Bitcoin not as an odd digital toy, but as a legitimate store of wealth, especially in times prone to inflation or political tension. The institutional spotlight on spot Bitcoin exchange-traded funds underscores that shift in perception. While not every major investment house is jumping in with both feet, the cumulative interest from some of them is undeniably intensifying, shaping a new financial environment in which ignoring Bitcoin altogether can be viewed as a strategic oversight. One telling sign of the times is that big names like BlackRock push deeper into Bitcoin accumulation, picking up a remarkable 9,400 coins this week. For a company of that size, it could be akin to a simple pivot, but for the crypto market, it is like a giant neon billboard that proclaims, "We see future growth." Of course, such moves can always be undone, but institutional players rarely partake in guesswork, at least not to the degree that we might witness from smaller retail speculators. If major asset managers make a substantial commitment to Bitcoin, it usually means they have done the homework, consulted risk models, and possibly see conditions pointing to significant upside over a medium to long-term horizon. Meanwhile, the short-term horizon remains full of unknowns. Some day traders are fixated on the possibility of a quick pullback before a more vigorous uptrend emerges. The unstoppable part may be that whales are not only refusing to capitulate, but actually doubling down during each moment of weakness. The push and pull dynamic ensures that the price has not collapsed, but it also has not vaulted beyond the formidable barrier we have been discussing. The tension around that critical zone near $108,000 to $110,000 forms the drama of Bitcoin's next act. History tells us that large inflows and sharp drops in available supply can lead to dramatic upward moves, but sometimes, simply an extended consolidation sets the stage for that flight when the right impetus arrives. These whales do not appear in a rush. They are methodically building positions and waiting for sparks to fly. If that catalyst happens unexpectedly, the momentum might be explosive. The crucial point is that the on-chain data does not lie, and it shows that whales believe in the potential for a major run. We stand at this crossroads, witnessing the interplay between short-term caution and long-term optimism. Whales, sharks, and institutions appear to be all in on a future that dwarfs the present. Retail participants, on the other hand, remain divided, torn between longing to see a new all-time high and fear that a dreaded price correction lurks. Some cautious souls ask if it might be wise to wait for lower prices, but there is no consensus that such a drop will materialize, especially if whales keep adding to their stacks. If the whales are correct, we might soon see a massive shift in sentiment. That alone could propel Bitcoin beyond the wedge and toward territory few dared to imagine just a short while ago. And so, will these new whale addresses, which have roared back to levels not observed in many months, mark the turning point for Bitcoin's next monumental surge? Are the whales unveiling clues about enormous catalysts hidden behind the static of day-to-day headlines? Only time will tell, but they can hardly hide their intentions. On-chain metrics are transparent for those who know where to look. The question is whether we can interpret these signals before the big wave crashes onto the shore, or if we will wake up someday to discover that the price has left the curious and the hesitant behind, chasing ever more ambitious heights. In the end, the drama and allure of Bitcoin revolve around that intersection of data, psychology, and unstoppable momentum. This is a frontier where whales quietly chart their course, while onlookers wonder if they should follow the footsteps of deep confidence or keep to the sidelines until a so-called confirmation arrives. No matter which route you choose, the intensity of this market is undeniable. Going forward, remember that the whales have made their move, and the big question remains, what about you? Thank you for staying right here until the end of this exploration into Bitcoin's evolving narrative of soaring whale addresses, institutional inflows, and high-stakes price consolidation. If this deep dive has fascinated you, kindly share it with a fellow crypto enthusiast who might benefit from unraveling these puzzle pieces. The story is evolving quickly, and it might just be the start of a larger shift in the balance of power that will define the next chapter of this digital phenomenon.